Assalamualaikum students, welcome back to lectures on international political economy. Sorry, last week I was unable to take your classes because of cough and flu. So let's resume our classes from this week onward. So so far we have started international trade system, and then we talked about the multinational corporations. This week and the next week, we will talk about the international monetary system or the international financial system. Now, the problem with with this international monetary or financial system is that the terms or the concepts used in the literature are usually not so common for students of social sciences, especially for students of political sciences or international relations. We do read a lot about current account deficit, balance of payment crisis, international financial crisis, but we really can't understand the exact meanings of these terms. So it is first important to understand the meaning of these terms, how when we say that our currency is depreciating, the economists come up with a lot of reasons for that depreciation, but we usually fail to understand those reasons because we cannot grasp the meaning of the terms they were using. So, in this lecture, this is an introductory lecture. We'll try and understand a few concepts that are frequently used by accountants or by economic experts. And then we'll try and apply those concepts when we will try and understand the structure of international monetary system in the world. We'll try and understand the history. We'll try and understand the issues, how a financial crisis happened. So, for all these to understand, it is important to first understand these concepts. And the concepts we'll study today includes the balance of payments, current account versus finance account. What is the difference between the two? Then what is account surplus, what is account deficits, and it applies to current account and financial account both. So current account surplus or current account deficit, financial account surplus or financial account deficit. Then we'll very briefly try and understand the foreign exchange system. How does it work? And value of money, or the better term would be the value of currency. So, how what is the importance of your the value of your currency? What How does it affect your economy? And how do we decide whether how much Pakistani rupees would be equal to US dollar or Japanese yen or Europe euro. So all these things we'll study in today's lecture, starting from the balance of payment. Now, the balance of payment is a very simple concept, and for this to understand, you guys need to visit bank, and if you have opened an account in any bank, you'll very easily understand the balance of payment system. So by the end of an year, you usually, if you have an account in bank, you receive a, a statement, and that summarized statement basically include all the all the monetary transaction you've made throughout the year. So all the payments that you've made that goes out of that account, in all the amount, all the money you have saved in that account or you have entered in that account. So all the income inflow and all the income outflow. The income inflow is the money coming in your account, and the income outflow is the money coming out of your account. Now, coming to the country's balance of payment account, this is very much similar to, but a little more complex than the account you have in your bank. So basically, balance of payment is nothing but it's a record of all the monetary transaction that people living in one country have made with people living in any other country. So if you go and purchase a product made in Pakistan and sold in Pakistani market, then that monetary exchange, you pay certain amount, you get a product, that monetary exchange would not disturb or affect the balance of payment of Pakistan, because all the transaction has been made within the country. But imagine that you have purchased a product, a US made product, or an Indian product, or a product in UAE. You went to UAE as a tourist, and there you purchased a product made in UAE, and then you come back. So that monetary transaction will affect the balance of payment of both Pakistan and the country where you've purchased that product, because there is an amount moving out of your country and going to another country. So there is an income outflow in your country and income inflow in another country. So balance of payment is actually the balance between this income inflow and the income outflow. But the thing I'm emphasizing again and again is that it needs to be an international transaction. It needs to be a transaction between the resident of one country with the resident of other country. Citizenship is not important. I mean, it is not really important that the resident of the UAE must be a citizen of that country. No, that's not important. But he or she needs to be staying in that country, so that he can affect the economy or the financial structure of that country, because he is earning amount in the currency, in the UAE currency, and he's doing monetary transaction on in the currency of that country. So this is, in more simple word, is the balance of payment. A money coming in a country and the money coming out of country by the end of the year will will develop a whole record of that, all the monetary transaction, how much money comes in, how much money comes out, and we'll see whether there is a balance of payment crisis or not, whether there is some deficit or surplus or not. And for that, you need to understand the two types of accounts a country usually hold. And this is similar to the accounts a person hold in a bank as well. So if you go and try and open an account in a bank, they will ask you whether you want to open a current account or a saving account. The difference is, the current account is an account that usually remains active throughout the year. So salary account are usually current account. Regularly, each month you get a certain amount in terms of salary, and then you try and purchase, for instance, you have to pay rent, you have to pay utility bills, you have to buy food, you have to, the regular kharche, the regular income outflows. This regular transaction, the money coming in and the money coming out in the current system, in the current year, the whole year, there is a constant monetary money coming in and out. It is usually balanced in a separate account called the current account. The financial account are similar to the saving account of a human, because these are usually made up of the amount you have saved to be used uh, mm, in another point of time. These type of exchanges are not frequent. These types of exchanges are usually longer term economic transaction. Similarly, if you've purchased uh, a bond, a share, and you've made investment in any business, so you know that that investment would take time in giving you profit. All that amount is actually a long term economic transaction, and these long term economic transaction, you usually keep them separate from your current account, and you usually keep them in this saving account, because you're not taking out money regularly from that account, and you're not adding in money regularly as well. uh, for countries, for nation, we use a separate term called the financial account. Uh, in the past, we used to use a term called the capital account, but now the most common term is the financial account. So financial account is basically a transaction that is longer term monetary transaction. Now, coming to the country current account, the current country financial account, most of the income inflows in a country current account is the money a country receive because of the exports of products. So all the businessmen who are exporting their products to another country, and are getting payments in the other currency. So all the payments we are receiving for exporting our product is an income coming in our current account, the country's current account. And similarly, the if you have if there is a foreign investment in your country, so all the profits and all the interest you're gaining in from your foreign investments, the foreign investment made by your country citizens, they are all they all came in the current account. And there are certain unilateral transfers from other nation, and by unilateral transfer, these include the foreign aid you receive from a country, and these include the private aid, the money you receive from private individuals or organizations, not from a country, but from private individuals. uh, the money that the your migrants living in any other country, they are sending the amount home to their friends, to their families. So all the money sent by your expatriates, all the money sent by your citizens living in any other country. So all these add up the income inflows in the current account. And the income outflows in the current account are usually the entire the reverse of the income inflows. So if you are purchasing certain goods and services from any other country, so to all the payments you've made for the imports of products, they they are the income outflows. Similarly, if you have to make a payment to foreign investors in your country, then in that case, this is the money going out, so it is another form of income outflow from the current account. And then there are unilateral transfer to other countries, so to other nations. For instance, if you are if your country is giving debt to another country, or aid to another country, sorry, not debt, the aid to another country, or if the citizens of your country are giving aid to any other country, or organizations in any other country, and if there are citizens of foreign citizens living in your country who are sending money to their home country. So in that case, there is a money income outflow, and all these income inflows and income outflows are short term, are regular. So these are all maintained in the current account. So by the end of the year, the country publish its current account, and in that current account balance, it includes all the exports, all the imports, all the foreign investments coming in and out, and all the unilateral transfers from and to the other nations. Uh, when it comes to the financial account, it actually measures the money inflows and outflows, which are based on foreign investment, foreign borrowing, foreign lending. So the foreign direct investment basically adds up in your financial account. The thing is actually that there are certain foreign financial assets like stocks, bonds, real estate, your land. And these foreign assets are either purchased by a country or individual. And so there might be foreigners who have purchased your financial assets in your country, the real estate, the stocks of your country, or the bonds, and the citizens of your country might be purchasing the real estate in any other country, and or the stocks or the bonds of businesses in any other country. So, income inflows in the financial account is when a foreigner purchase your financial assets. And if there is an income outflow of funds in your financial account, it means that your country or the citizen of your country, they are purchasing the foreign assets. Surplus is when the income inflows, either in current account or in financial account, when the income inflows, the income coming in is more than the income coming out. The income outflows are low, income inflows is high. So we say that there is a surplus. And then if there is income outflow is high, the income going out is high, and the income coming in is low, then we say that there is an income deficit, or the account deficit. So in case of the current account, if a country has a current account surplus, it means that the receipt or the earnings from the monetary transaction, from the export, are usually high, and the income going out for imports of products, for purchasing products from the other country, is usually low. So this is a case of the current account surplus. The current account deficit occur when you're purchasing more product from and when you're importing more products, you're paying a lot of amount in imports, and the amount you are paying for the exports you're getting because of the exports of product is low. Or similarly, when the unilateral transfers to the country is higher than the unilateral transfer from the country. Similarly, in case of the financial account surplus happens when the ownership of the foreign assets is increases. So if more foreigners are purchasing your assets, your financial assets, in that case there is mm, a financial account surplus. And if you are purchasing foreign assets, if your citizens of your country is purchasing a lot of foreign assets, then in that case there is a financial account deficit in your country. Now, the current account deficit or the financial account deficit does not really decide whether a country is a rich or a poor country. US, for instance, has for a large period of time, it has a current account deficit because they pay out more for imports, investment income to foreigners, and the unilateral transfers are usually high. Um, and usually, in order to balance that current account deficit, they need to raise funds on the capital and financial account. On the saving account, they try and have a surplus. So they increase their foreign debt, or they attract investments from abroad. So people from all over the country are willing to buy their financial assets, and by selling off their financial assets, they earn a lot of income to balance the current account deficit they have. So, if you have a current account deficit, it really doesn't mean that you're a poor country or you're a poorly managed financial country. Um, but current account deficit, if you have a current account deficit and a financial account deficit both at the same time, then it really means that you are in a your financial situation is in bad shape, and you are suffering from a balance of payment crisis. Now, coming to the exchange rate system. The exchange rate system is the most simple system everyone going abroad have experienced. And since now, due to internet, we regularly learn about the exchange rate of money relative to the exchange or to the US dollar, or to Japanese yen and all that. So, for this reason, the exchange rate system has become quite a normal phenomena for students of social sciences, except that there are some technicalities that they need to understand. So, if you have ever traveled abroad, have to convert your currency to the foreign currency based on certain rates which are predetermined, and which tend to change, which are very volatile, that keeps on changing. And it's basically made to to keep a standard for international monetary transaction. When we try and have a free market economy, a global free market economy, that means that there will be a monetary transaction between two countries, and this exchange rate system ensure that all the monetary transactions are according to a certain standard. And there is a currency rate system. So every currency has a decided rate with respect to another currency. There are usually two terms we use, and this is a special vocabulary when we talk about the foreign exchange rate. So, if a currency foreign exchange price rises, that means that it is more valuable in relative to other currencies, and we use a term called that we say that it appreciates, the currency is appreciating. And if the foreign exchange price of that country falls with respect to other countries, it means that it's less valuable relative to other currencies. So we call that this is the value of that currency is depreciating. And this appreciation and depreciation of a country is a common phenomena. We regularly hear that the currency, the US dollar is appreciating, then it's depreciating. So this appreciating and depreciation, it's a regular thing. It's not, it's not a linear system that if a currency appreciates, it appreciates for every other currency. It usually appreciates for single currency. Yeah, it's true that if your currency rate is rising, it affects its value with respect to almost every other currency. But since every other currency is going through its own changes, so by the end of the day, by the end of the closing of the exchange rate, you can decide whether your currency has appreciated or depreciated. There is another important term you need to understand: the hard and soft currency. So if your currency is acceptable outside your home country, and this usually based on whether your currency rate are stable or unstable. If your currency rate are usually stable, then in that case your currency is considered to be a hard currency. And a hard currency and is usually issued by usually the large economies, countries which have predictable economic systems. So there you can predict the currency rate, and that's why these currency, for instance US dollar, they are traded widely, and they have a very well-known values. You can use this hard currency not only in the home country of the country that is issuing that hard currency, but also in other country. For instance, you can use US dollar in UAE, in the entire Middle East. Soft currency is usually currency of unstable economies, countries which do not have a very predictable economic system. So they can be used in home country, but not elsewhere, because the value of that currency is very uncertain. And the volume of the possible transaction is not sufficient enough to support an international trading network. So you cannot use that currency in all countries. So usually the less developed countries, they have soft currencies because of the instability of and this is where the politics come in. So if you have political relationship with most of the world, and you are constantly doing monetary exchanges with the most of the countries, your exchange rate, or your economic system becomes more and more predictable, and that predictability and stability of your economic system improves the hardness of your currency. If your political relationship with the rest of your diplomatically isolated, if your political relationships are not good with the rest of the country, rest of the world, if you're not doing a lot of monetary exchanges with the world, if you do not have an open market, in that case your currency would be a soft currency, would not be used in any other part of the world, because it will be difficult for anyone to exchange that currency with US dollar, or with the currency of that country. And that's how the importance of the exchange rate comes in. So basically, And the exchange rate basically decides whether your currency is in demand, whether people are willing to buy your currency or not. And that is depend on a lot of factors. There are several factors that influence your currency value or its foreign exchange rate. The most important of all is the inflation rate. So, a rise in inflation rate means there is a rise in the overall prices of the products in your country. That means that for if the price of a product is rising, for instance, um, in one dollar, you can have uh, a good uh, food to eat. I mean, a good amount of food to you can eat a good amount of food. You can purchase good amount of food for your intake in just one US dollar. But in one rupees, you cannot have an enough amount of food. So basically, the price of the product, the inflation rate is high in your country, so the value of your currency is low. You cannot buy a lot from 1 rupees in comparison to the one US dollar. So the rise in inflation means the decline in the value of that money, and that decline would make it less attractive for the foreigners. And so it's the purchasing power of that your currency has declined within its home country, and so foreign buyers would prefer not buying your currency, and this would result in depreciation of your currency. The currency rate because if the foreign investors or buyers are not buying your currency, that means that the more you basically if your currency is attractive to most of the world, it means that its rate is high. So inflation rate basically reduce its attractiveness and reduce its rate, so it results in depreciation of that currency. Interest rate do the reverse. So if the interest rate of of a in a country is improving or increasing, that influence the desirability of the investment in that country. Because, for instance, if the interest rate rise in Pakistan, and then the demand for the Pakistani rupees would increase, because more in foreigners would purchase your bonds, and more foreigners would be interested in making interest earning investments in your country. um, so that would affect eventually the foreign exchange value of the your currency. Similarly, if the interest rate in your country declines, that results in the that reduce the demand of Pakistani rupees, and since the demand of that rupee, because more investors would avoid purchasing your Pakistani bonds, they would not make a lot of investments because the profit will be in Pakistani rupees. So all this would affect the currency rate of Pakistani rupees, so it will depreciate. Now, the current account deficit in the current account, that means that you are spending more money in importing products, and you are earning lesser money in exporting products. Let imagine that you have to purchase a product from India. So you will buy that product from India, and you will pay them in Indian rupees because that's the currency they are using. So, for instance, a Pakistani went to India, they purchased a product from India, they gave that sailor or businessman an amount in Indian rupees. So the value of the Indian rupees increases because the transaction is basically in Indian rupees. Now imagine that an Indian comes in Pakistan and they try and purchase a product in Pakistan. So now they will pay an amount in Pakistani rupees, and that means that the amount of Pakistani rupees would appreciate because the demand of that Pakistani rupees is increasing because the demand of your products are increasing. Since most of in case of current account deficit, most of the transactions are in foreign currencies because you are actually purchasing more product. So in that case, the current account deficit would depreciate your your currency. Your product is basically not that attractive for the foreigners, and they are not purchasing it, so they are not actually making transaction in your currency, and that would depreciate the currency. Now the terms of trade, the just like the current account deficit, the terms of trade influence the the exchange rate with with the help of the export and import process. Basically, the terms of trade is the ratio of the export prices to the import prices. So a country's terms of trade improves if the export prices, so not just the volume of the export, but the price you're paying in your export, if it's rising, and if the import prices are low, and if the export prices are high, in that case, there is a terms of trade is high. So, if the export prices are high, if you're getting a lot of money in through exports, then there is a lot of and your revenue is increasing, and this rise in revenue would increase the demand of your currency, your country's currency, because it will be more stable, and that would increase the currency's value. So, your currency would appreciate if the terms of trade is higher. The public debt is basically the debt owned by the central government. So all the amount we are all the income that has been taken by the central government from different countries and the financial institutions, the public debt is called that. So the public debt is it does not directly affect the exchange rate, but it indirectly affects the exchange rate because when a country has a is publicly indebted, it's less likely to acquire foreign capital, and it actually results in the rise of inflation rate. Public debt actually influence the inflation rate, and when there is a rise in inflation rate, it and affects the it appreciate your currency. Finally, the political stability. So political stability basically influence the currency strength by deciding whether a foreigner would make investment in your country or not. So if a country has a little risk for political turmoil, then foreign investors would be more attractive in making investment in that country. The because of the results of the foreign investments, you will be getting your current account surplus would increase if they're purchasing your bonds, if they're purchasing your financial assets. In that case, your financial account would be surplus. So that increase in your uh, you know the current account surplus and the foreign account surplus would influence the currency value. The currency would be more attractive to the foreign investors, because and you must have noticed that all these factors are actually interlinked. So if there is a political instability, usually the inflation rates gets higher as well. Countries usually become more and more publicly indebted. If there is a political instability, obviously, and the countries would be importing more and exporting lesser, because they won't be able to manufacture a lot of products because of the situation in the country. And for MNCs would avoid that country, so there will be lesser foreign direct investment in that country. So all these factors are actually interlinked, um, and the interplay of these factors results in deciding whether currency of a country would appreciate or depreciate. And as I said earlier, uh, each country's currency is constantly changing with respect to these factors, and this is actually so in the global foreign open market, they keep record of all these factor, how many what is the rate of each country's currency, and for on the basis of that currency's value, they decide the exchange rate, they decide they know that the value of that currency of US dollar is this, and Pakistani rupees is this and that. So the relatively, when we try and compare them, this will be the exchange rate of Pakistani rupees with respect to the US dollar. So this is it. This is today's lecture. I know a lot of difficult terms were included. So if you have any question, if something is not clear, you can definitely ask me. So thank you.